Hello students, let us continue with valuation of goodwill. So till now we have done average profit method. Under that I have already done one question from simple average method and one question from weighted average method. Now today I will be starting with super profit method. Okay, from super profit method we are going to find the value of goodwill. Okay, then after this we will do what? Capitalization method and annuity method. Okay, now while explaining goodwill concept, I discussed about this particular example. Okay, under this example we had three companies or three businesses. Okay, and they have invested what? Same amount of capital. This is new business, these are what? Old businesses. This was established 5 years before and this was established 10 years before. Okay, if you remember. Now after 1 year this particular new business have what? On 10 lakhs profit by investing this particular capital. Okay, so this is what? Normal profit. So this particular company doesn't have any goodwill because this was just started 1 year back and this is doing its business and it has on 10 lakhs and this is normal profit. Okay, but this particular business on 15 lakh rupees and this 15 lakh rupees is more than 10 lakh rupees, 5 lakh more than 10 lakh rupees. So this 5 lakh rupees is your extra profit, and this extra profit, how it has happened? Because of goodwill. Because of goodwill this extra profit 5 lakh rupees has happened to be business or this particular business. And if we see in this particular business, then it has got 20 lakh rupees earning and it is more than 10 lakhs. Normal profit is 10 lakh for new business, but it has got what? Extra 10 lakh rupees earning. So this extra 10 lakh rupees earning is how? Because of the goodwill of this particular firm or this particular business. Okay, so it has built recognition, it has got customer base, everything. Okay, because of that goodwill now it has earned more profit than normal profit. So that more profit, extra profit over and above the normal profit is called super profit. Super profit, here is 5 lakh, here is 10 lakh. So according to the super profit, by taking super profit, now we are going to find the goodwill. Okay, in case of super profit method. Clear? Now a super profit method. So the formulas are like this: goodwill is equal to super profit into number of years purchase. Simple. Okay, first you have to find out super profit and number of years purchase. As you already know, number of years purchase is given here in your question only. It will be given in your question, no need to worry, but you have to find out super profit. So that extra profit you have to find out, and when you multiply with number of purchase, it will be value of goodwill. So how are you going to find super profit? Super profit's formula is what? Average profit minus normal profit. So average profit minus normal profit. So you have to find average profit. Okay, you know how to find out average profit. Now you have to find out normal profit as well. So normal profit, what is the formula of normal profit? Normal profit is equal to average capital employed into normal rate of return. Okay, normal profit is equal to average capital employed into normal rate of return. Okay, so this normal rate of return will be given in your question. Okay, like 10%, 5%, 15% and all, but you have to find out average capital employed. Now again, how are you going to find out the average capital method? We have got this formula: average capital employed is equal to opening capital employed plus closing capital employed divided by 2. Right? But if opening capital employed is not given and closing capital employed is not given, then we have again two approaches to find out average capital employed. That is asset approach and one is what? Liabilities approach. Okay, so Under assets appraise method, how are you going to find out average capital employed? See, the method is asset at market value, not in face value, but you have to take asset at market value, okay, minus outstanding liabilities. So when you deduct outsiders liabilities from assets at market value, what is outsider liability? That debentures, creditors and all, okay. When you deduct it, it will be capital employed. So after this, after capital employed, you have to minus half of the profit on during the year, okay, half of the profit during the, it will be given half of the profit during the year, okay. So when you deduct it, it will be average capital employed, okay, average. This is one way. So note here, non-trading asset and fictitious assets should not be included. Should be included. It should not, non-trading asset and fictitious assets should not be included, okay. While taking assets at market value, we should not take fictitious asset. Do you know fictitious asset? Like preliminary expenses in the balance sheet, discount, okay, discount on issue of shares, profit, debit balance or profit. If those things are there in your balance sheet, you should not consider those as a assets, okay. You should not include them. So only you have to include assets at market value, then you have to deduct outside the liabilities, then it will come capital employed. Then after deducting half of the profit on during the year, you will have average capital employed, okay. Now the liabilities approach is, now liability share capital, okay. You have to see internal this thing, okay. Share capital plus profits, okay. Then reserves you have to add, then loss in balance sheets, okay. Loss, debit side, whatever you have losses are there, okay, like profit, debit balance, okay, discount on issue of shares, okay, even the goodwill, okay. So these are fictitious assets, these are losses in balance sheet. When you deduct it, it will be capital employed, okay, it will come capital employed. When after deducting same thing, half of the profit on during the current year, you will have average capital employed. This is from what? Liabilities approach. So if closing capital employed and opening capitals employed are not given, then you have to have any one approach. Either you go with asset approach or liabilities approach to find out average capital employed, okay. So generally this average capital employed is given in your question, at least in graduation level. If not given, then you have to find in this way, okay. Now let us do one question from super profit method, okay. In respect of the business carried on by a trader, the following particulars are available, okay. So profit on for following 3 years, okay. Profits are given for 3 years, 18, 19, 20s profit 50,000, 55,000 and 60,000, okay. So normal rate of return is 10%. So normal rate of return is given, okay. Normal rate of return is 10%, okay. Then average capital employed in the business is rupees 3 lakh. So no need to find average capital employed here because it's already given. No need to go with asset approach or liabilities approach or closing opening, it's already given. So it's an easy question, okay. Now again, present value of an annuity of rupee 1 for 5 years at 10% is this thing. This one is also given but not necessary for this particular question, okay. Then the profit included non-recurring profit on an average basis for rupees 3,000. So the profits, whatever profits of 3 years are given, there is a what? Non-recurring profit. Non-recurring profit on an average basis of 3,000. So you need to deduct this non-recurring profit because this is abnormal profit. which cannot be happened in future time again and again. Okay, you need to deduct it. Then you are required to calculate the value of goodwill on the basis of the 5 years. See, 5 years purchase of super profit method and annuity method of valuation. So this question you have to solve by two methods. One is by average purchase super profit method, and one is annuity method. Okay, so let us solve it with super profit method first. Okay, so as we already know that super profit methods, goodwill is equal to super profit number of years. So super profit is average profit minus normal profit. Okay, so normal profit is this. So let us find this. Super profit is equal to average profit. You need average profit. Okay, so let us find out average profit. So what is the formula of average profit? You already know average profit is equal to total profit of the past year divided by number of years. Okay, so total profit for 3 years are given here. Okay, see, 50,000, 55,000 and 60,000, 55, 50, 55, 60 divided by 3. Okay, so it is 1,65,000 divided by 3, it will be 55,000. This is average profit. Now you have to adjust something, as abnormal loss, abnormal income, everything you have to adjust. Okay, so in your question it is given that profit include non-recurring profit on an average of 3,000. So this is non-recurring profit, you need to deduct from this. So since this is for average, you need to deduct after average profit. Okay, from all the years, so we are deducting averagely. So we have got average profit 55,000, we are deducting 3,000, so it will be rupees 52,000. This is average profit. Okay, so we have calculated what? Average profit. So average profit is calculated. Now you require normal profit. So how are you going to find normal profit? Average capital employed into normal rate of return. So average capital employed is given already. See, average capital employed is 3 lakh. So normal rate of return is how much? 10%. That is also given here, 10%. So simply we are writing normal profit is equal to, see, this is average capital employed 3 lakh into normal rate of return is 10%. So 10 into 100. So it will be normal profit is equal to, when you cut this thing, it will be 30,000 is your normal profit. Okay, then super profit is equal to average profit minus normal profit. So your average profit is 52, normal profit is 30,000. So when you deduct this 30,000 from 52,000, it will be 22,000. This one is what? Your super profit. Okay, now what is the value of goodwill? Now value of goodwill is equal to super profit into number of years purchase. Okay, so goodwill is equal to super profit into number of years purchase is here 5 years, which is given here. Okay, it is the 5 years purchase of super profit. Okay, so super profit into number of years is 5, it will be 1,20,000 is your value of goodwill according to the super profit method. Okay, now since you are also asked to find out the value of goodwill under annuity method here, annuity method. So annuity method is very simple. Annuity method of finding goodwill, goodwill is equal to super profit into annuity value. Okay, simply you have to write super profit is your 22,000. We have already found that 22,000 is your what? Super profit. Hope you understood this. Into annuity value you have to find from your question. Okay, so annuity value is here. Present value annuity for rupee 1 for 5 years at 10% is rupees 3.78. So 3.78 is your annuity value. When you multiply super profit by annuity, it will be your goodwill's value. Okay, so this is how you can find value of goodwill using super profit as well as what? As well as annuity method. Okay, so till now we did this particular thing. Annuity method also very easy. This average profit done. Now we have to do capitalized method in our next video. Thank you very much.